Welcome to the daily update where I'll go over the action in the market for Monday, July 14th, and we'll see how things look for Tuesday, July 15th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. Kind of a quiet day. The market's really holding up quite well. The resilience is impressive at this point. We're still looking extreme as far as sentiment is concerned. We even ticked up a notch. We're above 75 at 76. And we didn't see any really big down move because of the trade news and tariff news that came out over the weekend. And you've got the buy the dippers coming in at any sign of weakness at all, and they drive prices back up. We're not seeing an awful lot of conviction, and the market's kind of lethargic right now. But that's to be expected, because we're going to have CPI coming out in Tuesday's session, and that's the second biggest economic report of the month. So there was probably just some wait and see ahead of that. The futures are up a little bit. This is 8 or 9 hours before the market opens, so there's a lot of time for things to work out there. We also have a number of earnings reports that are going to be coming out. The big banks are going to report before Tuesday's open, and that'll have an impact as well. So there's some big things just lurking in the background that could have a real impact on market sentiment overall and whether we go up or down. Okay, so right at the open, we did have a lower open. We opened Sunday evening with the futures gap down. They tried to bounce back up a little bit. Not a lot of damage was done there. You've got a market that's pretty much desensitized to any of this trade news and tariff news, and plus it's kicked down the road. Now a lot of the things that are coming out say, okay, now they have until August 1st to see if some kind of a deal is coming out. You had a pretty big announcement that Trump made about Russia and the potential for tariffs and sanctions and things like that because of the Russia-Ukraine war. And the market could have just really taken that and gone down because of it. But right now, because a lot of these negotiating tactics, that's what they're being seen as, are being used, the market's like, okay, all right, we know about that, but we're not really going to react to that at this point. But we ended up having a lower open, and prices were very choppy. We chopped between the daily pivot to the upside at 62.56, and we got down to S1 to the downside at 62.42. And then we just chopped around a little bit, and then we started to climb up from that. We climbed above the unchanged level to go positive, and we rose up to 62.70. We just almost got up to R1, not quite. But then we just chopped sideways to close slightly below the 62.70 level. We were up 0.14%, not a big move on a percentage basis. We're still below average with volume. Not a surprise there. We're still positive on all time frames. Short, intermediate, and long term, we're above all the moving averages. We're seeing interest rates continue to tick up a little bit. We're a little bit concerned about that. Maybe there'll be some reaction to that with CPI because of the inflation data that's going to come out in Tuesday's session. And as I said, earnings are going to start to come out as well. When the banks report, earnings season never really begins and ends. It's just a whole lot of earnings reports come out and then not very many, and we kind of trail off, and then it starts up again. And we're just getting ramped up for that now. And then, of course, the geopolitical things. Israel, Iran, Russia, Ukraine, and all the different things that happen with that really isn't having a real big impact on the market. Okay, some comments. Both the NASDAQ and NASDAQ 100 closed at new all-time highs. So, and that's growth. And to see those doing well. It helped the S&P to hold up fairly well. Not a great day for mega caps, but they held together at the same time. There's a proposed 30% tariff on the EU and Mexico that may start August 1st. It's not starting right now. It's like, okay, we still have a little bit of time between now and then. Maybe something can be negotiated. And then the head of the EU's Executive Commission and the president of Mexico expressed a willingness to negotiate a better trade deal before August 1st. That was taken more as positive, kept things together that way for the market. Then President Trump announced secondary tariffs on Russia of up to 100% that could start September 1st if Russia hasn't agreed to a ceasefire or an end to the war with Ukraine. So some efforts are trying to be made to get that to finally end as well, or it could get kind of nasty too. And we still have kind of a long list here, but not all of our indicators are on here. We're losing that positive upward momentum in the short term. The StochRSI is not on the list, but the Williams percent R is. The CCI charts are not on the list, but we have the stochastics. They are. And then we're still looking extreme with the slope oscillator, and we continue to be far away from the 20-period moving average. In the intermediate term, the balance of power, that's still looking extreme there. The TTM squeeze, and these aren't on the list all that often, so this is suggesting we're more overbought in the intermediate term. We're still in the +3 channel with the standard deviations chart. The rate of change, that's been on the list and will probably be on the list for a while because we came up out of those lows from April, and that's still being used as part of the calculation. And we're still looking rather extreme with our momentum oscillators, but they're slowing down. They're showing a little bit of weakness, and I'll show you that when I go through the charts. And we're also still far away from the 50-period moving average. Price is well above that 50-period moving average. And we're turning more negative again with the bullish percent indexes. They're actually declining, but they're still giving extreme positive readings. Then no change with the overall scenario with the Fed right now. We'll see if anything comes out because of CPI that gives the market some kind of an idea of, okay, what's the Fed thinking about this? The dollar is continuing to bounce up. So that it's actually, according to stockcharts.com, in the short term, it's in an uptrend now. Not according to the charts that I look at, but they measure things in a little bit different way. That's why I show those charts, because I have my way of doing it. I want you to see a different way that it's calculated by somebody else, just to see that there's more than one way to look at these things. And interest rates did tick up. We're at 4.43%, where we had been at 4.42%. You could round that down to 4.41 after Friday, but we are ticking up there, and we're still below that 4.5% level. But the context of this is interest rates have been going back up, and that's at some point, if that's to continue, may cause some problems for stocks. Sentiment is still extreme positive. We ticked up to 76, where we had been at 75, and we've been at this level now for about a week. We had the one day off for the 4th of July. That's where we hit 78. And sentiment has just remained extreme ever since then. Which can happen in a positive environment. But we're seeing kind of the reverse of what we were seeing back in March and April, where we were way down below 25 and just camped there for many, many days. Now we're kind of seeing the other side of that, where we're camped to the upside for many days at this point. And we're still positive with our trend. We are trending. We're above the moving average. We're above 20. And the bias is positive because we had the slight up day. Not a real day of conviction, but it was still up nonetheless. And our momentum is still positive as well. We didn't have any economic reports in Monday's session, so there's no charts to show you there. And here's some Isabel Net blog charts. This is current equity positioning finally starting to come back to the even level here, where this pretty much follows the market. If the market's going up, we see more people getting into stocks. If the market's going down, we see them getting out of stocks. And then also exposure to equities from commodity trading advisors. They're starting to get a little bit more bullish here. They could go higher than where they're at. right now, but at least in the scheme of things, we're back to looking a little bit more positive overall as far as their exposure. And then the average tariff rate, okay, so tariff action so far gets us up to this dark blue area. If the August 1st rates go into effect, then we'll be up to this area, and then other countries at April 2nd rates, that bumps us up a little bit more. And we still have really yet to see what kind of an impact that's going to have economically. Of course, there was the reaction to it last March and the Liberation Day, and now they're thinking maybe August 1st will be Liberation Day 2, so the sequel, something like that. And then we get this from time to time. Not an awful lot of changes here. When we look at forward PE ratios, we use that 10, 15, 20 scale. When we're above 20, we're considered to be expensive. Well, the S&P is at 22. And then there are some sectors, the 11 sectors that make up the S&P, they're even more expensive, with tech being the most expensive, discretionary, which has been improving lately, and industrials, which have also been fairly strong. They're more expensive than the S&P itself. And then staples are still considered to be expensive. That's equal with the S&P. And then even materials and communication are still above 20. And then we start to drop down with healthcare and energy actually being more fairly priced at the current time, according to the PE ratio looking forward. Then looking at hard versus soft data, and I'll just go through this at the top. All year long, the Fed told us there was no reason to ease monetary policy simply because pessimism had increased. When hard data, these are actual economic reports that come out, so it's a number that we can actually focus on. It was still showing strength. However, since the end of May, the hard data, the reports have been really going down. Here that says they've collapsed. And we've been seeing that. And if you watch these videos day after day, you say that I keep saying the economic reports lately have been weaker than expected. And that's what we're seeing here with the red line. It's really going down where the economic surprise index is actually going up. So we're seeing a little bit of a disconnect between the two. They get out of line with each other from time to time, but typically they tend to move in the same basic direction. We're seeing a divergence here right now. Then ETF flows, and a lot of money is going into Ethereum, which is a crypto ETF. It saw its record largest weekly inflows since it launched, and didn't launch all that long ago, but a lot of money going in there. And a lot of folks, instead of getting into the market directly, just like they do, instead of buying all 503 stocks that make up the S&P 500, we'll just buy a mutual fund or just buy the SPY. All of those stocks are included in that ETF or in that mutual fund. And so there's ETFs now that you can get into instead of having to manage the whole scheme of things or what's actually happening here. You can just manage the ETF itself and keep your eye on that. And then institutional investor risk appetite, it's coming down where we were getting quite bullish here, but it's still, as we approach the latter part of June, is still considered to be pretty high. This is from State Street. It's their index. It closed June at near record levels and saw over 5-year highs during the month. The big money is very bullish on risk assets, and we've been seeing that. And the smart money hasn't been really active. I mean, they're active every day, but that's why I wait later in the day to see what's the conviction of the market right now. And we're not seeing an awful lot, at least over the last few sessions. That's when the smart money comes in and either buys or sells. And lately, they've been doing more buying than selling. And then the big money, again, is very bullish on things, which can read as good or bad for stocks. I don't see it that way. What I try to do with all the charts I look at and the analysis that I do, follow what the actual smart money, not the big money, not like hedge funds, but the real smart money, figure out what they're doing and then just do the same thing and jump on and go for the ride. And then when it looks like they're stopping and starting to sell, then we switch over and look a little more negative on things. Over the short term, we think that their confidence is a positive, and it's been keeping the market together, at least lately, and we're seeing some of these gains from that. You combine that with FOMO, and then you combine that with chasing things like a lot of hedge funds do, which they might be big money, but they're not necessarily the smart money. And that's why we're not very far away from all-time highs with the S&P 500. Okay, then hedge funds and staples. They've been getting into a lot of staples lately. Again, they're big money. They may not be the smart money. They bought the dip in staples as the sector was net bought for the second straight week. Last week's net buying in the sector was the largest going back, blah, blah, blah. They're buying a lot of staples right now. This would be a more defensive play. This is toilet paper and toothpaste. And again, I don't they do have an impact on the market, but they're not necessarily the smart money. And so, okay, are they going to be doing things that actually oppose what the real smart money is doing? It would seem like that, at least according to this chart. And then a lot of money going in, being spent, capital expenditures, and it's projected to be 1.15 trillion from 2025 through 2027. And this is a sign of health. These are the big companies, the tech companies, Microsoft, Meta, Alphabet, Amazon, dumping over $1 trillion into capital expenditures to expand, to do research, to grow. And that's really positive for the overall market. And of course, a lot of that's going into AI. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. All right, so here is the chart. Not an awful lot of conviction, but we did have more of a positive bias after we got through the open. We chopped between the daily pivot. We did break down to S1, but just didn't stay there very long. And not seeing an awful lot of trending overall, just a lot of chop sideways. And then we finally broke higher, got above the unchanged level, chopped around there. We got up to the 6270 level and then just chopped sideways right there, drifted a little bit, and then closed just a little bit below 6270. No real big change ahead of CPI coming out for Tuesday's session in the initial overnight session. We did go down when the futures opened Sunday evening, but then we were able to claw our way back and actually repair a lot of those losses as the market opened. And still looking good here. The blue line's still above the red line for the most part. Both lines are continuing to go up. This is the intraday growth versus value chart. And came down a little bit with the growth to value ratio for the S&P, but overall we have been really going up since we saw that big decline right on July 1st when a lot of value stocks were bought that just really sent this ratio going down. But since then, it's been recovering. So on an end of day basis, growth was up, where value was actually down, and it was up more for the mid caps, and it was also up for the small caps, where we were virtually unchanged with value for the small caps. A little bit of a bounce here. Looking at the end of day growth to value ratio for the small caps, still positive overall. Also a bit of improvement with the mid caps, and an improvement in trying to break out a little bit here with the S&P growth to value ratio. This going up is more positive for the market. Still holding on to being above the rainbow with this growth to value ratio, but we haven't broke out to a new high here that was set back in late 2024. And we are still seeing, for the most part, discretionary. When you do the equal weight way of looking at things, that's been improving overall, where staples have been going sideways. And so that's been helping the growth to value, the discretionary to staples ratio here. And just late last week, we finally generated a golden cross with this ratio. So looking at the short-term trend, still positive. Even though the green line's coming down, it's far above the red line. We're still above the moving average, and we're above 20. So the short-term trend here is positive. Also looking at a positive intermediate-term trend with the green line above the red line. Volume dropping off, no surprise there. We're continuing to be below average with the S&P. And then this is the weekly chart that we get. It's a composite of a bunch of different sentiment gauges put together, still coming in extreme. So we're seeing some confirmation there. Shorter term, the one that I look at is the fear and greed index put out by CNN Money, and that changes many times during the day, and then they have a closing value each day. This is a chart that we look at once a week, and it combines a lot of different things together. And so that's confirming that we're pretty exuberant as far as sentiment right now. Here's another sentiment gauge just a little bit above zero, where we finally were clawing our way back with the Goldman Sachs look at sentiment for stocks. And this is coming down a little bit. We were a little concerned here. When this red line's going up, that tends to be more bearish. These are legal insider transactions. And the context now is that we're actually declining, which could be more positive for the market. We did go up with the VIX, but we are still below 20, both with the line chart and the bar chart. We're still below the moving averages with the VIX of the VIX that measures the volatility of the VIX itself. And I'm not showing the MACD of the VIX because it's just flatlined sideways right now. Seeing a little bit of a contradiction here. We ticked up a little bit with this fear gauge where the other fear gauge actually ticked down slightly. So not confirmation that way. We did go up. This could be some pre-CPI hedging that's going on with the daily equity put call ratio. And we're continuing to go back up, which tends to be more negative when this is rising with the 5-day chart. And we're pretty much flat. We slightly declined with the 10-day chart. So it's not seeing a lot of conviction there. Still above the band with the volatility risk premium, but we've been just going sideways with the most recent readings. Still positive with the advanced decline line based on price and volume. And we are continuing to drop with the 10-day advanced decline oscillator, but it's still above zero, but it continues to come down. That's showing a little bit of internal weakness longer term because it's a 10-day moving average of the advanced decliners. And declining, but still above zero with the advanced decline ratio. Starting to roll over with the 5-day and the 10-day moving average. And it's because we've been seeing, for the most part, a contraction of the new highs. Now, they were pretty good in Monday's session. Kind of bolted up a little bit here. We're not really seeing any expansion of the new lows. So this is still holding up for right now and actually showing a little of an improvement. Looking at accumulation distribution, we're positive. We're above the advancing moving average, but we're still below the moving average when we look at the boom indicator. So shorter term, it's more negative. Positive with the Chaikin money flow, the red line's going up, and we're going up with the Chaikin oscillator as well. So if you go back to the accumulation distribution and use the more conservative approach, all three of our smart money indicators are positive. But if you figure out the movement that we've been seeing lately with this indicator, then in the short term, you could also interpret that as being negative. And we're still positive with the vortex, with the green line going up and the red line going down. Still looking solid above advancing moving averages with all the indexes that we follow for the advanced decline line studies. Ticked up slightly, still above 50 with those stocks in the S&P above their 20-period moving average. We also improved slightly with the 50 period, 100 period, and we actually declined a little bit with the 200 period moving average study, but still above the 50 level. That's the line that I use between positive and negative. So just not really much happening. Just kind of a little bit down, a little bit up. We're losing that higher highs, higher lows look that we had been getting, although we're still very, very close to setting another new all-time high. If we do get up to that level, volume continues to be below average and the moving average continues to decline as well. So not really much of a change here with the 20, a little bit of a tick up with the 50 and a little bit of a turn up with the 200 period moving average study on the S&P. We're actually dropping below the midpoint with the StochRSI. It's actually picking up a little bit of weakness, or at least a loss of positive momentum currently, where we're still looking extreme positive with the Williams percent R, but we're declining with the CCI 14 and 20 chart. And the short-term stochastic still dropping down below the moving average, but giving us an extreme reading, rolling over but still positive in the intermediate short term, and still declining but extreme positive with the long short-term stochastic. Still above we're still positive with the force index, but still below the midpoint. The condition of the short-term trend based on 20 periods, we're below the lines right now, but the lines for the time being anyway are continuing to go up. We're in the +3 channel of the standard deviations chart. That's when we're looking rather extreme. And we switch over to the intermediate term. We tick down a little bit with the balance of power, but we're still above this black line. That's why it's extreme positive. Still looking good here with the 10, 20, and 30 period moving average steady. This green line is acting a little bit as short-term support. Positive with the go, no go, since it has the darker blue bars. Still near the blue line here with the highest high value chart. And still getting a little bit long, even though we're positive with the Landry light. Right near the end of June, we started to go above this dashed line. That's when we're looking a little bit long according to this particular indicator. It just means that this uptrend has been going on for quite a while. But we are positive with the proper order. That hasn't changed. We're just a little bit above the black line here and still looking positive with the lighter blue with the TTM squeeze. And declining, but still above this red line with the rate of change going back 50 periods. Still flatlining, but slightly above zero with the ease of movement. Still positive with the Arun. The oscillator's above zero. That means there's more buyers than sellers. And we ticked up, but we're slightly negative with the S&P McClellan oscillator. So now we're more negative with the summation index based on price, starting to decline a little bit more here based on volume. We'll see if that's going to turn around and go positive on Tuesday, or is this some weakness that's starting to come into the market? Declining, but still above zero, though, when we look at the NYSE McClellan oscillator. So we're still going up with the summation index based on price and volume for the NYSE summation index. And we, after seeing this decline all last week, even though we set new all-time highs with the S&P, the swell trading oscillator was continuing to decline. Well, it ticked up just a little bit here in Monday's session, both based on price and volume. And we're still extreme, and now just kind of going sideways with the PMO, still above its moving average, rolling over based on price and volume, but still above the moving averages when we break those out. Declining and actually dropping a little bit below 50 with the PMOs that are above zero. So they're seeing a little internal weakness there. We're declining but still above 50 with the buy signals and rolling over but still giving us a pretty high reading with the PMOs that are above zero. Neutral with the Elder's Impulse system, positive with the parabolic SAR, still extreme because we're above the green line here with the slope oscillator and still above the moving average. But the MACD is showing a little bit of weakness now. It could be starting to roll over below its moving average. So the two short-term oscillators, they're still looking pretty good. The intermediate term is where we're seeing a little bit of rollover, and we're positive with the TRIX and KST here, but we're already extreme with the TRIX and we're near extreme with the KST. Rolling over, but still positive with the Copic curve. Actually, no longer extreme positive. We dropped out of this darker green area into this lighter green area. Still positive with the Sean trend meter, but not as strong as it was. Still above 50 with the money flow and declining, but still above 50 with the ultimate oscillator. Still above the moving average with on-balance volume. Not extreme, but still above 50 when we look at the RSI 14, that's intermediate term, and the RSI 9, which is short term. Intermediate term trend, we're still below the red line, but it's continuing to go up, and the blue line is also going up. So the intermediate term trend is hanging in there for now, above all the plotted moving averages, but we're still far away from the 20 and 50 period moving averages, even though the boom indicator is declining. And still below the moving average with the bullish percent index for the S&P. We're also declining now with the NYSE bullish percent index, and declining and still extreme positive with the bullish percent index for the NASDAQ 100. Still getting a printing bottom fisher buy signal here, so that's still on the books for the time being. And now we have the new week that's starting. We're still looking pretty good when we look at the weekly chart overall. It's really going to help if we could continue to go up and probably test this R1 overhead resistance level. If we even get up to that point, that would involve setting a new all-time high. So the trend slowing down here. You can see a lot of doji candles right here. That means the open and the close are right near each other with the Heiken Ashi chart. We're positive with the Kagi chart, Renko chart, and three-line break chart. So the trend is still positive that way. And we are still strong here with the 150 after almost getting up to this 350 level here, but we're declining a little bit with the 150 and 200 period moving average study. Then this is a variation of a chart that I usually show over the weekend. I put my trend lines in a different place. I try to connect this low down here and then measure this a little different way. This chart has us coming right about up to the midpoint, where we did see that in late 2024, and this ended up acting as resistance, and then that took us down into the March and April lows that we dealt with earlier on. So this might be a little bit of overhead resistance longer term for the S&P. Positive across the board. Somebody finally updated the chart there at StochCharts.com. So now we're above the 200-day moving average with the small cap. So everything is positive right now. Bonds are negative across the board, but you notice the dollar is now positive in the short term, according to the way they measure things. So we had communication, a growth area that led things higher, that helped keep the market together. Financials, maybe a little bit of a bounce. We've been a little concerned with that, and I went over it in the weekend videos. We're seeing a back to a breakdown of the ratio between the financial sector and the S&P. We'll see if the earnings coming out, if they're positive, if that helps that overall ratio. A little bit of a dead cat bounce probably here from real estate. And then we had energy, which was one of the stronger areas periodically last week. It was the weakest area on Monday. And tech ended up being down slightly. Discretionary was up. Okay, so a lot of green here. Discretionary had a BPI cross back above 80. We just saw a bearish one where it crossed below 80. So it's like, make up your mind. And initially, the NASDAQ saw some weakness. We read these from the bottom up. And so we started lower, but then we got above the 20,600 level. And then with the NASDAQ, not on here is the NASDAQ 100, which also set a new all-time high. And Canada is doing quite well right now. That's the TSX, is the Canadian, their main index there. So not a lot of real positive things as far as tech. A lot of red, a lot of down, but not big time here. Where the financials, awful lot of green here, maybe some front running ahead of earnings being released. Amazon and Tesla were up. That helped discretionary, and communication had Google and Meta that were up. All right, and so we're just getting close to a golden cross here with the Dow, unless we see a big crash. And even then, there probably still is going to be a golden cross that way. And I read something recently. They think on the 17th, which will be Wednesday or Thursday or so, that's when they figure that the golden cross may actually happen with the Dow. And that would be the last major index, because to me, the major indexes are the Dow, which is not at a golden cross, the S&P, which is the main one, NASDAQ and NASDAQ 100. It's nice when the small caps and mid caps are participating, but they still have a ways to go to get back to a golden cross. Neutral, with the diamonds looking at the Elder's Impulse system. And here, up 0.27% with the NASDAQ setting a new all-time high, but still neutral with the Elder's Impulse system. Also up 1/3% with the NASDAQ 100, and still neutral that way. And it's kind of strange. Here we are setting all-time highs, but yet the Elder's Impulse system is blue. That means more neutral. And it's like, okay, this is a market that looks a little bit tired or needs some kind of a catalyst, positive catalyst, to really drive things to the upside. But then we're coming into the middle part of July, where we're ending the real strong part of the first 2 weeks of July. And then we saw, and I did a video about this that's on the YouTube and Rumble channel as well as the website, where we're just keeping an eye on things, not predicting anything, but it's like, okay, it was about this time in 2023 and again in 2024 where we're looking good through about the middle of July, and then we saw a fairly significant decline. It was more of a decline in 2023. It was shorter term, but actually higher on a percentage basis in 2024. So again, it's not that that's necessarily going to happen, but we just want to be aware of that ahead of time in case it does start to happen. And we're still kind of drifting down here with the momentum, actually looking negative with the momentum for the NASDAQ 100. Still dealing with this longer term trend line on the NASDAQ 100 weekly chart, which may be acting as part of the slowdown that we're seeing. Still above the 200-day moving average with the S&P 600 small caps, and looking a little more constructive here with the Russell 2000 small cap index above its 200-day moving average. Neutral, though, with the Elder's Impulse system for the small caps, sideways with the mid caps, and neutral with the mid caps with the Elder's Impulse system. Still looking okay here. Just kind of going sideways now with the Wilshire 5000 as well as the total U.S. stock ETF. Financial sector was up 0.75%, but not back to an all-time high. This is what I'm talking about. We fell down below the 200-day moving average with the financials to S&P ratio. We did bounce back up, and maybe we'll see some strength out of this if the earnings are taken as positive. And the FANG index kind of going along sideways, but still positive. So Apple was down over 1%, still above its 50-day moving average. Microsoft was down just a little bit, but in a pretty solid uptrend. Recent golden cross from Amazon, and it was up 0.3%. Google above its 200-day moving average, up 0.76%. Meta was up almost 0.5%, holding up fairly well there. Nvidia was down a little over 0.5% after hitting that $4 trillion mark for market cap. And we were up over 1% with Tesla, and just kind of coming back to this conglomeration of price and the short and longer term moving average with each other. Netflix could be continuing to come down to its 50-day moving average, even though it was up over 1.33% on Monday. And seeing a weakening now of the relationship on the short term between U.S. and world stocks. That's coming down in a little bit of a drift down with the longer term correlation. Oil was down, getting back more into the mid 60s where it had been getting up into the higher 60s. And the dollar, now it's down here because the chart that I use here, it trades virtually 24 hours a day. I go with what was the dollar at the close of the stock market, and it was up at that point. But we still have a ways to go just to get back up to the 50-day moving average. And here's the reading. This will be the last reading that we see for Truflation before CPI comes out. So we'll see. They came out with 2.4% the last time CPI came out. They're coming in at 1.71 now, which is quite a bit less. The Fed's trying to get under that 2% level, but they use mainly the core PCI for that metric for inflation. We're watching this 4.5% level with the 10-year yield. We're still below it for right now, but if that really starts to go back up, that could pressure stocks. And we're continuing to go down over the last few sessions with the 10-year based on price. Going back to being regular or non-inverted, uninverted here with the 10-year to the 3-month yield curve. And still looking okay here with the Qs to S&P. We're finally coming above the moving average with discretionary to the S&P. Still above the advancing moving average when we compare large cap growth to large cap value. So still above the moving average with the large caps, going back above the moving average with the mid caps, bouncing back up, but still below a declining moving average with the small caps. We're still declining here with the Staples to S&P ratio, and that's positive when this ratio is going down. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. All right, so earnings season, it's starting. It's going to get underway this week. The big banks, they're usually the ones that kick it all off here. In Tuesday's session, we're going to get Wells Fargo, Citigroup, JP Morgan Chase, and these will come out before the open on Tuesday. We're still positive on all time frames, and we are trending at this point, and we're going to get CPI. So we got earnings coming out and CPI. Those are some pretty big things happening all right around the same time before the market opens. We'll also get the Empire State Manufacturing as well, and then anything geopolitical, which for right now, unless there's a real escalation that impacts the markets between Russia, Ukraine, or Israel and Iran, it's mainly tariff news and trade wars and things going on there. And then in Wednesday's session, we're going to get PPI. That's the another pretty influential inflation report that we'll get. Then on Thursday, initial jobless claims and retail sales, and then probably the bigger one will be on Friday, which is consumer sentiment. So here is a look at what's coming out on Tuesday, what the previous readings were, and then what the forecasts are. We'll see if the market beats or comes under the forecast. Seasonality, we're positive with the Dow, neutral to negative with the S&P, and neutral to positive with the Nasdaq. So take your pick. We've been really positive as far as seasonality for the first part of July. Now we're starting to get into the second part of July where we don't see as positive seasonality here. We're also dealing with options expiration. Friday will be expiration day, but we do tend to be up 57% of the time, down 43% of the time, going back to 1980 for July's options expiration. So here's a look. Now, during a post-election year, we still have a few days left here of this positive seasonality before we start to flatten out. This also shows that same thing with the green dashed line, which is the S&P 500 during a post-election year. Now we're starting to focus more on the second half of July. We're done with the first half, and the market did quite well during that time. We'll see how things go forward from here. And this is also the positive seasonality. In another day or so, I'll probably drop this out of the video because we're getting up here to the middle of July now. And then this is a new one put out by Carson. The first half of July tends to see most of the gains, and we were pretty good this year. And then it's not that we turn around and tank in the second half of July. It's just that we see things really slow down. So the warning signs, we still have the S&P McClellan Oscillator and Summation Index. They're still below zero, so that's being treated as negative right now. The bullish percent index for the S&P is below its moving average, but it's still giving an extreme positive reading. And the momentum for the NASDAQ 100 is negative. And then the long-term special K chart, which I went over in the weekend videos, that continues to be negative. And then our three smart money indicators, again, the boom indicator is negative, but the accumulation distribution itself is positive. Chaikin money flow is positive, and the Chaikin oscillator is positive there. We're looking better here with our growth to value and discretionary to staples ratios for the S&P. And the NYSE McClellan oscillator, even though it declined, it ticked up a little bit, but it's still above zero. So that makes the summation index continue to advance. And the Swindle Trading Oscillator had been on the negative side. Now it's back over on the positive side. The Parabolic SAR is positive, as are the bullish percent indexes. Now, I don't go above or below the moving averages with these two bullish percent indexes. I just do that for the S&P. The reason these are still positive is because we're extreme positive with the NASDAQ 100, and we're still above 50 with the NYSE. And it's positive, but seeing a bit of a slowdown, especially in the intermediate term with the oscillators for the S&P as well as the Copic curve. The ease of movement is positive, money flow, ultimate oscillator, vortex. Those are all still positive, and the financial sector is positive. We'll see what happens in Tuesday's session there. And we do have this praying bottom Fisher buy signal, even though we really didn't hit much of a bottom when this signal was generated. Here are the pivot points for Tuesday's session. So we'll see if we go to the upside and hit the resistance levels or actually go down and start hitting support levels. So the conclusion, no change. This has been the same, positive on all time frames, and we are trending currently. Thank you. I hope you have a wonderful day, and I will talk to you in the next video.